What's good, family? Today, what we're doing is a super special episode, and we went through, scrub every single question that we had in the comments. So, as videos are dropping, I want you to let me know what you need. Drop our questions, comments, concerns in the comments so we can pretty much give you as much value as possible. So, I think today, like, it's probably about a little bit over 100 questions that we frequently get asked. So what I want to do is pour back as much as possible in explaining these questions because you can only get so much via text. So I want to answer all questions today to make sure you're getting as much value from the channel as humanly possible. So let's jump into it. And I got my guys behind the camera. I would call them the Batman and Robin. MJ and Pippen. I would call them Shaq and Kobe. I'm talking about D Wade and LeBron. I'm talking about Jeremiah and Devon, man. How y'all guys feeling today, bro?
Good, man. Feeling good over here.
Let's get it, man. So let's pour into the people, man. And any questions that y'all want to ask me along the way, like if it's just a random question, to say elaborate on that a little bit more, or break it down to where we can understand it as well. Because listen, man, this is gonna be a master class for the people, man. So let's jump into it, man. Let's answer these questions, man. It's gonna be a long one, you two. So let's get to it, bro.
Playing Russian roulette with the banks.
Okay.
Is that a topic for us today?
Somewhat. Yeah, somewhat. We're gonna get into a lot of the different best credit cards and overall strategy. So it's a lot of information. We got over 100 questions today, so
Gotcha.
we're gonna get to it, bro.
So I would say, I've been knowing you for a minute, and I be looking when we be posting this content. I look a lot at the comments, and one of the biggest questions that I see first that I want to ask is what's the difference between a credit score and a credit profile?
That's good. Most people get the credit score confused with the profile. Your credit score is, I always use this analogy. Your credit score is your GPA and your credit profile is your transcript. So whenever you talk about your credit score, you could have a 800, but that doesn't mean that you have a fundable profile, because you can add credit builders, you can add authorized users and get a very high score. And always remember this, that the banks don't lend to you based off of your score, they lend to you based off of your profile. So that analogy is perfect. Your GPA versus your transcript. It's what's on the transcript to determine what colleges are going to accept you. You don't get accepted into college just saying my GPA is a 4.0. They want to look at the quality of classes that you took to determine if you're qualified for this specific major or niche that you're trying to go into.
And so it's all revolved around credit. What is considered a good credit score then?
So you got to understand the factors of the profile. I would say a good credit score is, I would say 720 and above. While some people may consider it high, if you have a 720, this is essentially telling me that you're only battling utilization. Oftentimes you can have like a low 630, but it's a multitude of things that's going to get you a 630. And anybody that's in the industry, if they have studied credit and have an in-depth understanding of it, you'll know based on when somebody tell you their credit score what they're battling. So if you're below 600, more than likely that's going to be charge-offs, collections, potentially like a bankruptcy, just different things. But in totality, if someone has a 720 and above, the worst that they're going to be battling is utilization, which is, they owe a little bit on their credit cards.
That's crazy you say that, because I got a 630, and I know we was talking about that yesterday. How long do you think it could take a person to build good credit then, getting a 720? Like if they have that, that stuff you're talking about in their credits?
It's going to vary per person. That's a thing. And I'm glad you asked that question, because it's not necessarily the score in which we should be chasing. Like most people chase the 750, they chase the 800. The score really means nothing, because it's more about what's on there to get you to where you at. Because I've seen multiple people with a strong 630 or strong 650, and then they can walk into the bank or credit union and get access to way more capital than a person who has an 800 with no credit history.
Dang. So for the people, what makes up a credit score? What makes up my credit score then?
So the general factors of a credit score is your payment history, it is your utilization, how much you owe on a credit card, the age of your profile, the inquiries, new credit, and then the age of the new credit, right? So it's a multitude of factors that go into it, but that's just what is graded upon. You see what I'm saying?
Gotcha.
So I wouldn't too much focus on the individual factors, but knowing them is very key, because if you have 100% payment history and then you have low utilization, your score will always be up high. And then different banks and institutions judge you off of different factors. So for example, Bank of America, if you have too many recent new accounts, they're inquiry sensitive and new account sensitive. So just understanding the factors of it lets you know which institutions to go to.
And I've heard some people. Now I know some people with some high. I ain't gonna lie, they got some amazing credit. But I've also heard, why did my score drop after like they didn't paid off a loan?
Okay, that's good. So essentially what happens is, right, and all of this kind of flows from the credit score versus credit profile conversation we're having. Whenever your credit score falls due to you paying off a installment loan, or whatever type of funding that you have taken out, that's actually better for the profile, because the score drops, but the individual profile end up getting better simply because you paid back in full what you borrowed. So that's a factor that goes into your credit score, which is recent new accounts, the account history. Once an account closes, your actual age decreases on your overall profile. So that's a reason why the score drops. But in totality, the profile got better because you showed that you could repay back $20,000, $30,000, $50,000 or whatever it is that you borrowed. So that happens a lot. And actually it's better for you for your score to drop and your profile get better in that aspect.
So utilization is a big part of this. But if you can break that down in layman terms, why does that matter a lot? I know that's a big part of this.
So whenever we're looking at the score, which makes up the profile, the utilization is the second most important factor on your consumer report. So essentially what happens is, if you have high utilization, and especially if it's reporting with personal credit, it shows that you are high risk. It shows that you're using access to capital and you are maxed out. The rule of thumb, and I always tell people this, don't go over 30%. Right? So total utilization, never go over 30%. Or if you can actually go and use it and then pay it off. You can use 100% of your available credit if you're going to pay it off, because now you get a recent high balance, and then this literally puts you in position to get access to higher credit limit increases, because it shows that you can manage what they have already gave you access to.
What is the difference between the statement date and the due date? People are asking that a lot in the comments.
Statement date is the date that the statement for the previous period closes. The due date is whenever the actual minimum payment is due for that particular card. So remember this, you need to have a minimum payment due for the due date, but by the statement date, you should pay it off in full, because whenever that statement closes, it's going to reflect that balance. I'll give you another example. Sometimes people will go in, they will use a credit card up. If it's a $10,000 credit card, they use the entire $10,000. When then they pay it on the due date, it is paid, but if you go back and reuse it again, whenever the statement closes, it's going to show you have 100% utilization, even though you paid it off on the due date.
You got to be strategic with this.
So you got to know the difference between, that's why I say always make the minimum payment on the due date, but on that statement date, make sure you pay it off in full. So therefore, you're not battling high utilization.
So you got a lot of cards.
Yeah, I got a lot, bro. I got about, we probably like 41 or 42 now.
And you keeping up with all of that information?
So I separate my cards. So if I have a balance on the card, it's going to be in one wallet. If it's a zero balance, that's in a completely separate wallet. And also for me, I don't use credit cards whenever it has passed the 0% APR phase. So if I got to borrow the money and pay you interest on it, that's too expensive for me. I only like to get access to capital at 0%. But you know, once every 6 months or once every 9 months, you got to go through and use your personal credit cards so they don't get closed on you. Because if you have inactivity or it's a dormant account, sometimes they'll close it.
So how many credit cards should I have?
That's a great question. It's depending on where you're trying to go. Like, I would say for the average person, if you're just starting out, I would say on the personal side, no more. I don't think you need more than probably about 10 to 12. And then that's a lot. You see what I'm saying? But for the average person, no more than 10 to 12 personal credit cards. But on the business side, it's unlimited. The reason why is because they don't report to the personal profile. So we get business credit cards, we max them out, invest, build other relationships. And then from there, we rinse and repeat this cycle.
Repeat. Oh, and so this, take it back two questions before this. You had pretty much said it. So this is why you might have to close credit cards in a way, just based off of certain things or parameters.
I wouldn't recommend to close certain credit cards simply because whenever you close the credit card, which is a revolving account, once you close this credit card, like that account is closed. You can't reactivate it. So you'll lose that age. So I would recommend to just keep it and use it maybe once a year just to keep it open.
Keep it open.
Because what you're adding to is the age.
Absolutely.
The longer that you have a credit card, the longer your age is going to be.
Okay.
And that's the average age of accounts.
Let's turn it up a notch. What is a hard inquiry?
Okay. A hard inquiry is whenever you apply for any type of credit at an institution. It could be an auto loan, it could be a loan, it could be a personal credit card. For some institutions, it could even be a checking account. This is whenever they actually go and pull your credit. And a hard inquiry is whenever they're doing an in-depth analysis.
So I know you got your hards, just like you said, but I know there's also a soft pull.
Mm-hmm.
Does that hurt me? What is a soft pull?
So a soft pull is like, man, you know, whenever you get different letters in the mail, you'll get a pre-qualification and you'll
I
get,
be wanting to see if it's real too.
you see what I'm saying? They have soft pulled your credit just to see like what I would say it's like looking through the window. That's the analogy that I'll give for that. It's like looking through the window to see what's inside, but they can't go inside to see. So a hard inquiry is whenever they go and pull it, right? They see exactly your balances, how long you had the car, all of these things. And then a soft inquiry is whenever they are just looking at a snapshot of the profile, score, potentially utilization, and then maybe a limited amount of other factors as well. But it's not as an in-depth pull as a hard pull.
And how often should I check my credit report? Because I be checking, I ain't gonna lie, I be checking it pretty frequently.
Man, I check mine multiple times a day. Like just go and look.
See, I ain't that crazy. Dang, I need to be doing
like, because you never know.
You never know.
I would say,
you
see what I'm.
what happened to Rico?
Yeah, exactly. Like, and then you never know that somebody can go in and get access to your personal information, and then they're applying for credit cards, and you look up, and because you don't check every day, you look up maybe, let's say, next month, and then all of a sudden you got 13 inquiries on your profile. Somebody has opened up 7 new accounts under your name, and they already maxed the cards out. Would you want to wait 30 days to find out this information?
Jeez, because I only check like one. I gotta up that checking. Yeah,
I'm checking multiple times a day.
I only check like probably 2 times a week. Dang. Okay.
I check multiple times, and how I check multiple times a day is that I get notifications because I got so many different cards.
Yeah.
The due dates are going to be changed, and then my wife and I added on credit cards with each other. So anytime she get a utilization spike or something go, I'm getting a notification. Then I'm just going to check. So I'm leveraging TransUnion, Experian, Equifax. I have my FICO. I got Credit Karma. So I use multiple credit softwares to
Smart Credit.
Yeah, I'm signed up with them. So yeah, bro, it's a lot. I check multiple.
And this is not even one of the questions. It's off it's really not. I'm still on subject. How important is credit? Because like what you just explained in these last 10 questions. How important is credit?
Credit is it's one of those things that has always been around, and it's a leverage tool for us to truly get ahead. I personally feel, if you stay in the United States of America, you have one of the greatest opportunities with this system that has been not necessarily set up for us to leverage, but if you get access to this information, you're now equal playing field. So if you can go and get access to 100,000, 200,000 to grow, scale a business or invest into your personal brand, why are you not leveraging this? Like the homeless man that's staying under a bridge right now can walk into an institution and get access to $20,000 or $30,000 based on his current profile. Even if he have nothing on there, open up a checking account, go in, apply, and he could potentially get access to $20,000 or $30,000 and literally change his life.
Mm. And so when it comes down to, that goes into the next question, when it comes down to applying, which bureaus you think matter the most, Experian, Equifax, or TransUnion?
It's depending on your strongest bureau. So you have 3 different credit scores. Yeah. We have FICO scores and Vantage scores, and I think I got a question in there from the people a little bit later on. But whenever they're pulling your FICO score, they have to pull it from a specific bureau. And you got 3 different bureaus. Technically, they're called bureaus, but really they are consumer reporting agencies.
Break that down, because I always hear you say that, and then I hear other people saying that.
So technically, like, a bureau is governed by the government, right? But these are consumer reporting agencies, so they have to follow a different set of laws because they are reporting data. All they are data furnishers.
So they're not people in the computer in the office with a whole bunch of computers. And they're reporting everybody's data based off of the usage.
Exactly. So they're technically not a bureau.
It's just data entry about what you're doing.
They're not a part of the government. You see what I'm saying? They are consumer reporting agencies, and that's why we leverage consumer law for the consumer reporting agencies.
That's deep. What are authorized users, and do they still work? Because I know I'd be thinking about sometimes, should I put on my people, or, when I get to that level of having credit, do I need to, utilize that?
So I have a different approach and opinion whenever it comes to authorized users. Authorized users are great for boosting your score. They do get you a better credit score because if you have high utilization, you add an authorized user for, if you have $50,000 in utilization, you add an authorized user for $50,000 of available credit. Instead of you having 100%, you now have 50% because you added an additional 50, right? So it does help your credit score go up, but whenever you sit down and apply at a bank or credit union, they're going to see that this is an authorized user and you're not solely responsible for this individual account. So they can see if it says account type, it's going to say authorized user. You're not the primary account holder.
So it's best to be the primary.
It's always best to be the primary account holder and I call that like true comparables. Now, authorized user helps in this way. If I add you on my credit card as an authorized user and give you a physical credit card to where you can go and use it up to that limit, and then you go out and purchase things and then pay it back, you're building with the actual bank versus me just adding you and you never spending any money. So when most people do this, and I don't want to like bash anybody that sells authorized users, but it's not truly helping you get approved for high limit credit cards. Because if I add you on my credit card and you get that account added to your profile, your score does go up. But whenever they look at the payment trends associated with that account, you got access to a $50,000 Navy Federal credit card. You've had access to it for the past, let's just say 3 months or so, but they don't know when you were added. So let's just say that the age of it is, I got it 2021, so it's about 5 years now. You've never spent $1 on this credit card that you were added to, and we're supposed to think that you truly have access to this.
That's why it's best that you really be the primary on it.
Exactly, and what does the payment trend say?
I was just going to say, it's tracking.
You've never spent $1 on this credit card. Is it truly helping you with that institution?
And that's fire. That totally changed my mindset. Next question. This is a good one. How many late payments can destroy a profile?
1. Uno. No late payments. No late payments, but I also want to add this also. Whenever you're talking about late payments, understand that it is not as detrimental after 2 years. They hurt the profile, but after 2 years, they don't weigh in as much. So that's why you'll see A lot of influencers online say if you don't have late payments over the past 2 years, so the reason why they're giving you that framework, because after 2 years, it kind of, one late payment takes 2 years to, let's just say, even out. So if you get one late payment today and then you pay on time for the next 2 years, it takes 2 years to kind of even the playing field.
Damn, they don't play about late payments.
So late payments, because that's the number one factor on your credit profile is your payment history. So you going from 100% to 99% could drop your credit score 100 plus points.
Jeez. Can paying collections improve my score?
Credit people gonna kill me for this. Absolutely. That's how I repair my credit. One of the fastest ways to repair your credit is pay the people what you owe. So if a debt collection company or collection agency reaches out to me and say, hey, and it has to be an amount that you're feasible with. Entrepreneurs, business owners, anybody that is struggling with access to maximum exposure with your personal credit cards, business credit cards, structuring your LLC or corporation. It's a multitude of things that you are missing out on, stopping you from getting access to your first $100,000 at 0%. And what I want to do is coach you to your first 100,000 or your first million. No matter where you're at, you're going to get value from my $99 community where we break down everything from personal credit mastery, business credit mastery, travel hacking mastery, manufacturer spending mastery. Nothing is left off the table in this community. Listen, for only $99 a month, you can come and sit down with me and hundreds of other entrepreneurs and business owners and ask me rapid fire Q&A. How much would that be worth to sit down with a multi-seven-figure business owner to answer your questions? Most people say it's worth thousands, but I want to grant you access for only $99 a month, and you can cancel anytime with no pushback. I'll see you on the inside, and in my words, everybody eats. Let's go. Because I'm going to give you two different scenarios here. You can get a pay for delete, and then it's literally paid off and it's off of your credit report within 30 days. Or you can say you don't want to pay them and you can leverage consumer law, factual disputing, a multitude of things. And what ends up happening, it may take 6 or 7 months. So remember, you went through credit enhancement, right? Imagine if you would have said, hey, I'll pay you what I owe for this negative, inaccurate account. You wouldn't have waited for 6, 7, or however long you had to wait. You could have literally easily got a pay for delete letter, get it in writing or get it on recording of them saying that. And then you pay it, and then it's off of your credit report, and you could have been up and running within 30 days.
And is that the fastest way to rebuild bad credit?
That's a good one. Is the fastest way to rebuild bad credit with paying collections, or because some collection agencies don't even offer to pay for delete. So that's a tough question. I like that question there because it's like a twofold question. At times, yes, but other times, no. So it's one of the fastest if you can get a pay for delete. But if you can't get the pay for delete, I mean, you better off just fighting them and leveraging consumer law.
Do you treat this like a game?
Well, man, listen, this is all a game. Life is a game. And whenever you can, like, I'm pretty sure a lot of us, we all grew up, we all 80s babies, right? Most of us that's watching this channel. We played GTA.
Yeah.
This is real life GTA, except it's legal. So you can go out, you can do and make the money do certain jobs for you, and then which I call that is like deposit relationships. You can make the money, get you access to more money. You're leveraging the system over and over and over again. You can start with something as small as $1,000. And within a few months, based on what you do with the credit and the frequency of it, you can literally 100x your limit within 90 days. I've seen it happen before. I've seen someone come in with literally no credit cards whatsoever. They have maybe had a few auto loans. They pay their rent on time. They didn't use their credit at all. Went and got their first credit card for maybe like $2,000 or $3,000. Leveraged it, paid it back multiple times in a billing cycle. Took it from, I want to say like $2,500 and probably went to like $10,000 within like a 90-day time frame. Now they got a $10,000 primary on their profile. They leveraged that one for 3 months of history, and then they went to another institution and then they matched them what they got. So now you literally have the banks competing to give you more money so they can make money off the swipe fees, the transaction fees, and so on and so forth. So if we know the primary focus of a bank is to lend out money, why are we not going to the bank or putting ourselves in position to go and get the money from the bank? And it's strategic ways. I'm pretty sure we're going to get into it with some more questions. It's strategic ways in going out and getting access to certain funding, because not all funding is the same.
Facts.
Most people think that you can go out and get access to a credit card on the personal side and operates the same way that a business, and that's not true. So knowing what product that you need, because it does all spend the same, but the terms associated with it is completely different. Some money is some credit is very expensive, and that's what the people got to know. Because we hear certain things online, and whenever we hear it, we think that it's just face value. My credit score get to a 680, I can go and get 250,000. But the quality of that 250,000 may not be where you want it to be, because you got to take out, let's just say MCAs, which is merchant cash advances. They're looking at how much the revenue of the business is doing, and they're lending to you off of that, which comes at a higher interest rate. You can get the money, but it's going to be expensive money.
Yeah.
That's why I say build the profile up to look better to the bank so we can go in and get access to 0% funding.
Now, this question is obviously asked by, your community, and also asked by the people in the comments. I know it's a big one, and I want to answer. I want a great answer for this, because I always think about this. What are quality comparables?
Man, it goes right back into what we previously discussed as far as the transcript and the GPA. Quality comparables are those from, I would say, like tier 1 and tier 2 institutions. So quality comparables are pretty much like the quality on your profile. We don't add, let's just say, credit builders. We don't add Kovo, Upgrade, Upstart, Best Egg. A lot of the things that people push, those are not true quality. So if you go and you add those, just think about in the future that banks are going to be judging you based off of what's on your profile currently. So most people, you can go out and get an 800 credit score with credit builders. Don't get me wrong. But whenever you try to go and get access to capital from the banks, they're looking at the quality of accounts that you currently have been, I would say, nurturing. And if you have low tier accounts, they're going to give you low tier limits.
Why do lenders care about my highest limits?
So it basically is saying what you are capable of handling. Because let's say that your highest limit on your credit card is $2,500. And you either use it every month, and that's what the max that you use, or you don't use it. You've never shown them that you have the capability of handling a $50,000 limit. So it's the history on what you have currently been able to leverage. That's why they care about the highest limit. And we always say, at least having 2 credit cards with a $5,000 to $10,000 limit is the foundation. As long as you got those, institutions start taking you a lot more serious along the way. So you don't want to have your highest credit card being $1,000.
And if it was $1,000, is that considered a thin credit profile?
So a thin credit profile is something whenever you don't have much to judge from. So maybe you only have 1 or 2 credit cards, and that's all you have on your profile. That's a super thin profile. You always need a mixture. So whenever people are, let's just say, specifically talking about a thin profile, we use credit stacking. That's what we do. We'll get to that later. But for the overall average consumer trying to understand what a thin profile is, this means that you don't have a list of quality comparables in the form of revolving lines and installment. We want mortgages, we want student loans, we want personal loans, we want auto loans, right? That falls under the installment. Each one of those payments are going to be the same every single month. That's why they're called installments. But then you also want a list of credit cards as well from quality institutions to where they can see that you know how to manage it, from BOA, Wells Fargo, PNC, Truist, so on and so forth. So you want to have a mixture of revolving and installment trade lines on your profile.
Age or number of accounts? Which one do you think is more important?
Man, that's a good one. I think they are intertwined with one another because age is how long you have been nurturing what you have access to. If you don't have at least or if you only have rather 2 accounts on your profile and you've had them for 20 years, that's great, but they don't have a lot to, let's say, judge from. So I would think they would be intertwined, but now as I explain that, I can't say they equally the same. I would have to say age, because if you've been with American Express for 30 years and you have a $25,000 limit on those cards and it started off at $1,000, that shows that you have great responsibility with $25,000. So I would have to go with age if I had to choose, because number of accounts, you can have 2 credit cards and then the 2 credit cards that you have access to could be $50,000 limits. You have a $50,000 Navy Federal and a $50,000 American Express, and that's $100,000 that you have access to with 2 institutions, and you've been with them for years. Other institutions are going to want to lend to you. So I would say age. That's a good question.
And now I got a 700 plus credit score. Why do I keep getting denied? Like with certain things that I apply for?
It's the score, not the profile. Because you could have an 800 credit score. That doesn't mean that you're qualified for funding. Because, for example, you could have Kovo, Upgrade, Upstart, Best Egg. These are also known as credit builders, rent reporters, Rental Karma, all of these things that, you know, other people use to leverage. And it's a time and place for that. If you're just trying to go and get the best rate on a mortgage, or you're trying to shop auto rates, like, you can add those type of things. But if you're trying to get access to the 0% funding, you can't add those type of things. So you could have a 800 plus profile or 800 plus credit score, but it's the quality. That's why we say we want quality comparables. That means nothing with credit builders. The banks are just knowing that you are trying to rebuild your credit. So if you get quality comparables, if you start with a $500 Bank of America card or a $500, let's just say PNC card, you are more quality than a person who has a $10,000 Best Egg.
Yo, okay, just click for me. So what you're saying is you really got to differentiate your score and your profile.
For sure.
These are 2 different things.
For sure.
Sometimes, I mean, all the times I used to look at it as just my score is my profile. I think most people probably think like that when we first start off with credit. So my biggest question next is, like you were saying, do store cards, because I used to have a store cards, do they help or add to your profile?
So whenever you're starting out, I don't personally recommend them, but if you do have them, and anybody that's watching this, if you do have them on your profile, let's just build on top of them. But store cards are not quality. Like, because you only can go and spend the card at those stores. If you get a Belt card, if you get a Target card, if you get a TJ Maxx and Marshalls and Home Goods card, you only can spend at those particular stores. Now, it is a revolving account. It is a primary credit card, but the quality, it's not a quality comparable. So I much rather you have a $1,000 Discover card before you have a $50,000 TJ Maxx card.
What's the difference between a Discover and American Express, but then Truist and a Chase? Are these under the same umbrella?
Yes, because you can take those cards and spend them anywhere. Anywhere Visa, MasterCard, American Express is accepted, you can go there and spend. You can spend it on multiple things versus just being directly spending the money in Target or TJ Maxx or Belk, Victoria's Secret. A lot of the store cards that people get, a Best Buy store card, right?
And then for the is American Express considered a bank?
Yes, it is considered a bank. They don't have a physical footprint, but they are considered American Express Bank. Yes. And sometimes you can get a co-branded card that's issued by American Express, Navy Federal. they have a co-branded American Express card. It's not the same as American Express. They're just the issuer, because whenever you have an issuer of a card, that's who is going to literally issue it. And then if you look at the logo on the bottom, it's only, I want to say, 4 logos. So it's Discover, MasterCard, Visa, and American Express. Because Chase is the credit card, but it's issued by Visa.
Yeah.
And then you got Visa, and you got Visa Signature, and that's a whole nother masterclass for that.
What's the difference between revolving and installment debt?
Revolving is a credit card, and installment is a loan. So let's say you get a mortgage or you take out a personal loan, the same exact amount is going to be due on the same exact date every single month for an extended time frame. 2 years, 3 years, 4 years, 10 years, right? So you got to pay the same exact amount every single month, and then for X amount of years. Revolving is you having access to credit, or credit card in particular, or a business line of credit. You pay it and then you can reuse it again. If you get a loan and you pay it off, you can't use that same loan again. The account closes afterwards.
Dang.
You know what I'm saying?
Okay. How many new accounts are too many in 12 months?
It's going to depend on who you're going to for funding, or who you're trying to go and get access to capital with, because certain institutions such as American Express, Wells Fargo, Truist, PNC, they're not as new account sensitive as Chase, Barclays, Citibank. Like, they are going to be, I would say, new account sensitive. And then there are, a lot of people don't like to, or maybe they don't know, or maybe they don't discuss them, but there are some unwritten rules in a lot of these institutions to where they say not American Express, but Bank of America has a 312 rule. Any more than 3 new accounts over the past 12 months, more than likely you're going to get a denial. That's if you're not an existing customer. But if you are an existing customer and you have more than 7 new accounts over the past 12 months, you're more than likely going to get a denial. So you just got to know like how each institution likes to lend out money, what they consider as risky. Because I'm going to give you this framework or this analogy. What you may be considering risky in a woman may be different from what I consider risky in a woman. You may not consider her going out with a guy friend and then going out to have drinks. You may not consider that risky behavior. For me, that's risky behavior. You see what I'm saying?
Got
So
you.
different banks, I'm going to view different things differently.
And based off of your track record,
You see what I'm saying?
your profile really matters.
The profile.
What's the ideal age for a mature profile, since we're talking profiles now?
2 years. I would say 2 years plus. Most people are going to say 5. And I'm going to tell you that the average person is not going to have a 5-year age history. How do you get a 5-year age history if you just start building out a year ago?
Facts.
Now, you can't add authorized users to boost your age up and do all of those things. But for the average consumer, you get to that 2 years of age history. And remember, this is a strategy here. We're building on the personal side so we can get to the business side. So once you go through and you get you maybe 7 to 10 revolving credit cards, quality, 7 different banks, right? Or you could get multiple credit cards with one institution. You could go to American Express and you can get 7, 8 different credit cards from American Express. But what you want to understand is strategically obtaining them in a certain sequence position you to, let's just say, you want to have 7 accounts, and from there, I want to build out with one institution or a multitude. But once you get with those institutions, you leveraging that relationship along the way allows you to look better. So my goal is this: we build on the personal side, we get to anywhere from 75 to 100,000, get you 5 institutions that you want to rock out with, and then just keep leveraging credit limit increases along the way. So you don't got to keep adding brand new accounts to your profile over time. So you get with 5 and you stick with them. multiple products from each of these 5 institutions, now your age is always increasing a long time versus you going out and you start with this institution, apply, get approved, and then 6-7 months down the line, you get a brand new card. You just decrease your age.
Got you. So in doing that, should I carry balances or pay in full during that process?
Most people are going to say pay in full, and I would recommend too, but sometimes you have to, let's just say statement date, due date, you have to show utilization on those particular credit cards, because if you have access to 100,000 and you never show any utilization, you can then be denied for having access to too much credit. So I would say being strategic in your pay down periods and understanding like when to pay down and when to carry a balance. You want to listen, a lot of people going to kind of have different of opinions on this. Sometimes you got to let them make a little bit of interest off of you, because hear me out. You setting yourself up to not look as risky whenever you do carry a balance. So let's play it out this way. You go through every month. This is one scenario, and you max out your credit card and you pay it down. You max it out and you pay it down. That's very responsible. You're always going to get the best rates. They're going to appreciate you. They're not making any money off of you, but they know that you're responsible. But then if you, on the flip side, go and max out a credit card, pay minimum balance. 1 month, 2 months, pay it off in full in a 90-day cycle. You have positioned yourself for future financial decline to not look as risky, because they know how you maneuver whenever you carry a balance. At most, you may wait 90 days. So it's not going to affect you as much as if you always went through, paid your credit card down, and then all of a sudden the payment trends are utilization here, payment 0. Utilization here, payment 0. Now utilization here, payment here as far as the minimum payment. Now they like, okay, maybe we need to cut his limits because he's on a financial decline. So sometimes it's good to carry balances to allow them to see how you maneuver in a certain, let's just say, financial storm. But then other times, you know, most people are going to say pay it off in full. So it's just really you pruning and nurturing that relationship with all of the institutions.
And that could be a reason why your score could fluctuate. Monthly. Okay. Okay. What is inquiry sensitivity?
So inquiry sensitivity is whenever, like I gave you an example of, you go into an institution such as Chase. They don't like you to have not only too many new accounts, but over a certain amount of inquiries. They consider it as high risk, because if you have more than, for example, the rule of thumb is to never have more than 4 new or 4 inquiries on your profile at one time, because it shows that you applied to 4 different institutions before you went to them. So
they really watching like that.
Yes. So whenever they pull the bureau, so if I go to PNC, which pulls Experian, and American Express, who also pulls Experian, I go to American Express and apply and get multiple credit cards. And let's just say, for example, that they issued 4 inquiries on my profile. Whenever I go to PNC, they're going to see that I applied for 4 different credit cards. That's why we getting spicy here. That's why we remove those inquiries before the actual account hits our profile. Because if the account is open on the profile with a brand new credit card with a new inquiry, and then you have made a payment on this credit card, they know that the account is yours because you paid on it.
That's why they deny you.
That's why they give you denial whenever you try to go in and remove it. But if you go in, get approved for the credit card, and before this actual account hits your profile, what ends up happening is they're not able to see it. So now you can get the inquiry removed, and then you actually get the account. Now, I gotta put a disclaimer in here. If you go through and get approved for a $30,000 or $40,000 credit card, and it's the highest limit that you got on the personal side, it makes sense to leave that inquiry. Because sometimes if you go through and remove it, they can actually shut the account down. So you gotta know when it is smart for you to remove that that inquiry on that profile.
And then what does too many like recent accounts mean over time?
Chase has a 524 rule. So if you have too many recent new credit cards that you've opened over a 24-month period, it's going to be an automatic denial. So if you have more than 5 new credit cards over a 24-month time span, Chase is like, that's too risky for me. And that's why we go to Chase first in our funding sequences. Because if you are new account sensitive, we need to come to you first, get access to the capital, and then the other institutions who's not inquiry sensitive or new account sensitive, we save you for later in the funding sequence.
Chess.
It doesn't make sense to go to Wells Fargo, American Express, and let's just say Navy Federal before you go to a Chase. Chase should be one of the first credit cards that you get and bill with because they're new account sensitive. You want to get them out the way first because it doesn't matter what you do after them. They only care what you do before them.
So you want to put the big boys in front.
Exactly. Especially the new accounts.
New accounts.
New account sensitive, rather.
How do lenders view maxed out cards? I know that's a big one.
Yeah, they look at you as high risk, but it's based on the payment trends. So if you went through and you max the card out every month and you pay it down, max it out, pay it down, and then you have a payment trend of like this, that's not high risk. But if you go and you barely carry a balance and then you max it out the very next month and you hold the balance for 3-4 months, you're high risk at that point. So it's all about being strategic because they're judging you. The only thing that you can dictate is your payments. That's all that you can dictate in credit. And it's a history of me paying. How many times have I paid the money back?
Facts.
How much have I paid back?
Facts.
That's really all credit is. Like most people try to make it complicated. All credit is my ability to repay credit.
That's it.
That's what it is.
That's a simple, when I see everything.
My
and that
ability to repay.
And that pretty much dictates your payment trends, like you were saying, the ups and the downs and whatnot. Mm-hmm. Okay. Does income affect approval?
Yes. Yep. Income definitely will affect approval because if you're not making money and you really don't have a way to pay the money back. So now it's a difference between projected income and actual income. So depending on how much you are requesting from the bank, that's going to dictate if they ask you for documentation. So what you put on the application is super important as well, because oftentimes what happens is people go out and they put these large numbers on the application and they're lying, right? Even if you are projecting yourself to make a certain amount, let's be realistic. You stay in a impoverished zip code. We're not going to say any zip codes because we don't want to offend nobody. But you stay in a zip code to where the average house value is $50,000, $60,000. But yet you tell me on the application that you make $2.5 million and you've been staying here. So you make $2.5 million and you staying in this zip code where crime rate is high. The average house value is $50,000 and you make $2.5 million and you're still living. Okay.
Something not adding up.
Something is not adding up. And that's how
frugal.
people get caught. I'm frugal. And that's how people get caught up into having to provide documentation.
And you already pretty much debt to income ratio is considered strong. That's what the next question. But before we answer that one, does that tap to what you just said? Does that tap into why banks truly want to, like, I hear a lot of people say no docs. Mm-hmm. You can get into no docs. Mm-hmm. But really no docs is when they still got to run your credit report.
For sure.
Yeah, so they still got to know you. Mm-hmm. I'm just going to give you money. But once they do that, they run a little, I don't know, soft pull or something, whatever they do, they see that, and then you don't have to because they see the trends. Mm-hmm. And then that's how you're able to not provide banking history or your business or something like that because they already trusted you based off a certain, I guess, about the trend and whatnot.
Yep. So it's the payment trends, your ability to repay. And then when people say no docs, that means that they don't want to provide the banker with no documentation or proof of income or proof of revenue.
Okay. And then last
if you say, real quick, if you say that you made $1 million in business and the bank asks and then you don't provide it to them, you're not going to get that approval. Because if you really did, you would be able to provide the documentation. Yeah. Even if it's gross. Because a lot of people confuse gross with net. But do you even have $1 million coming through? And this is a rule of thumb. Never inflate more than 20 to 25% of what you're actually making. Because if you can justify that 20 to 25% decrease, and whenever you're talking with bankers, like you got to truly understand, like they're looking at the numbers. They don't care about your feelings. They don't care about what you intend to do. They're looking at, if I give you this money, what are the probability and percentages that you're going to pay it back? And then it's a series of numbers that we're going to look at, such as your income, such as like how much debt are you carrying? It's a multitude of strategies and techniques to where they determine if you can qualify for 150,000. And then when most people go in there and say no documentation, that's just saying, I'm going to tell you something, but I don't want you to fact check me. The next question you were going to ask about the DTI.
Yeah.
I would say about, you're doing great if you under 40%. So if more than 40% of your, I would say like discretionary revenue or income is coming in and going to bills, that's considered like average.
Threshold.
You see what I'm saying? Because most people are at, like, if you want to be honest, most people like 65, 70%.
Especially in this time.
You see what I'm saying? So if you can be 40% or less, bro, that's excellent. So if less than 40% of what you bring in a month goes to expenses, bro, you're doing good.
Gotcha.
This is for the average person, by the way, because you got to think, bro, the average person maybe only making, let's just say on average, maybe 40,000, I think 40, 50,000.
Damn.
And then they got, what's average rent? 2,500, like somewhere around that area. Like you got the average auto loan now, $700-800. And that's average.
Yeah.
Like, bro, probably 50-60% of if y'all may have to fact check it on the channel, but I don't know, but I would say probably less than 40%. You're doing great.
Gotcha.
So with banks, we have to essentially understand that it's going to be a multitude of versions that they may pull. So we have a FICO mortgage, we have a FICO auto, and we also have a FICO bank card score, right?
So 3 FICOs?
It's actually multiple FICOs. So you got different individual. I think it's, some say 16, some say 20 different FICO scores, because you can have a FICO bank card score 8. You can have a FICO bank card score 4, FICO bank card score 3, the same with a mortgage and the same with an auto score. So whenever the banks are pulling an individual bureau, they're then going to pull an individual FICO score as well. So when most people say that my credit score is 830 or 800 and on Experian, that doesn't mean nothing if you're going for a credit card and that's your mortgage score. You see what I'm saying? So they're pulling a bank card, or they're pulling a mortgage, or they're pulling an auto. That's the difference between the three.
And what's the difference between a FICO and Vantage score? I heard about you talking about that a lot.
Yeah. So a Vantage is like, it's an old scoring model. It's like, for my people that watch sports, or specifically college football, it's like the BCS standings versus the playoff model that we have now. Like, we no longer are, playing in the BCS era to where you got to go undefeated, and then it's a playoff format. So Vantage is outdated. FICO is currently what they use. 99% of, I would say, funding is going to come on from a FICO based scoring model.
Okay. And which lenders pull Experian most often?
So let's do this. What I want to do now specifically is kind of go into the individual banks and or credit unions that's going to pull from each bureau. So as you can see right here, we have Experian, we're going to do Equifax, and then we're going to do TransUnion, right? So we're going to break them down this way. What I want people to understand is you understanding which bureau you want to get funding for dictates how you maneuver through your overall funding phase. So vertically, whenever you are going to one individual bureau, so if you're only going to leverage Experian, this is what we call a vertical Experian funding sequence. If you're going to leverage Equifax, this is a vertical funding Equifax. And if you're going to leverage TransUnion, this will be considered a vertical funding TransUnion type of sequence. So let's just go with Experian first. And as you can see here, some ones that pull from Experian is, we have Wells Fargo. We have American Express, also known as Amex. We have PSECU also pulls from Experian. You have Chase, they also pull from Experian. So whenever people are going out on funding rounds, what they're trying to do is go to one individual bureau and then go and strategically stack with that specific one. So if you went and got $10,000 from Wells Fargo, 10,000 from American Express, 10,000 from PSECU, 10,000 from Chase, you now have 4 inquiries on your Experian profile, but Equifax and TransUnion can't see it. So let's just say that we want to go to Equifax. This could be Truist, right? Truist is a great bank out here. We definitely leverage them a lot in the South. We also can go to PenFed, right? That's another one. Key Bank, primarily out of Philadelphia, right? A lot of, or Pennsylvania, rather, a lot of people that stand in that, geographical location, they like that. Another one would be First Citizens. So what we are doing is we're only leveraging the individual bureau. This would be your Equifax sequence. Now let's just say you were with TransUnion. This is the Navy Federal, right? Everybody loves Navy Federal. This is Fifth Third. This is Regions, right? All of these banks are going to pull from, banks and or credit unions are going to pull specifically from TransUnion. But if you can go and access $10,000 from each of these institutions, you're potentially looking at about 40 to 50,000 from each individual bureau. And, we got 3 different ones. That's access to over $100,000 that you're looking at right here on the screen. So just you knowing which bank and or credit union is going to pull from each individual bureau is how we overall leverage this entire process.
And this is sequencing based off of how
absolutely.
you're pulling.
Mhm.
Okay.
Yep. It's all sequencing. It's like knowing which institution to go to ask for what product. Now, from the chart that you just seen, that was specifically for like credit cards. If you're going for a line of credit, they may pull a different bureau. So it's all about you knowing which institution to go to for which product.
And that's why you got to have these relationships.
For sure. Relationship building is probably one of the fastest and most efficient ways to get access to capital in 2026.
How do you strategically? So is that stacking? And that's a part of stacking.
That's a part of stacking.
Okay.
And then, so from the chart that I just drawn, we went to each individual bank or credit union is going to pull from one bureau. But if you want to stack with one bureau, you go to those in specific. But if you want to say, I don't want 4 inquiries on my Experian report because I know Chase is going to deny me, or inquiry sensitive bank is going to deny me, you could go to 2 from Equifax, 2 from Experian, 2 from TransUnion. Therefore, you have all 3 profiles still with low inquiries on it.
You can get an AI to help you out, really strategically do all this instead of you
Yeah, for sure. But you still got to know. So AI won't be able to tell you, it's relying on certain data.
Okay.
And whenever I say it's relying on certain data, not everybody's situation is going to be the same, because you could be in Georgia and apply to one specific credit union and they pull TransUnion. But you could be in Texas or you could be in Florida, and then you could go to that same exact bank or credit union if they have a, multi-state footprint, and then they may pull a different bureau based on your geographical location. Like that was specifically for like credit cards. If you're going for a line of credit, they may pull a different bureau. So it's all about you knowing which institution to go to for which product.
And that's why you got to have these relationships.
For sure. Relationship building is probably one of the fastest and most efficient ways to get access to capital in 2026.
So is that stacking? And that's a part of stacking?
That's a part of stacking.
Okay.
And then, so from the chart that I just drawn, we went to each individual bank or credit union is going to pull from one bureau. But if you want to stack with one bureau, you go to those in specific. But if you want to say, I don't want 4 inquiries on my Experian report because I know Chase is going to deny me, or inquiry sensitive bank is going to deny me, you could go to 2 from Equifax, 2 from Experian, 2 from TransUnion. Therefore, you have all 3 profiles still with low inquiries on it.
And this is off subject, but it's still tied into it. You can get an AI to help you out, really strategically do all this instead of you
Yeah, for sure. But you still got to know. So AI won't be able to tell you, it's relying on certain data.
Okay.
And whenever I say it's relying on certain data, not everybody's situation is going to be the same because you could be in Georgia and apply to one specific credit union and they pull TransUnion, but you could be in Texas or you could be in Florida, and then you could go to that same exact bank or credit union if they have a, you know, multi-state footprint, and then they may pull a different bureau based on your geographical location.
So credit this way of credit is very still like it's best for you to do this shit. I would say not yourself, but like an in-person way, because I know you can apply for credit online.
Oh yeah, you definitely got to go into the bank. Like you can open up the checking accounts, all of that online, and make your deposits online. But the day that you're going in to apply for this particular product, credit card, line of credit, loan, whatever it is, sitting down with a relationship manager is always the number one rule of thumb. Like always do that, because you're able to insinuate what you need the capital for. And that's one of the things that I teach in my my inner circle and my mentorship is like we're developing loan packages to where we know based on data, based on analytics, why we're requesting 100,000, why we're requesting 50,000, right? Because if you go in and say, I want to get access to, you know, the highest limit on the credit card, like you got to have a reason for that. So that's like, that would be more of the in-depth teaching that I offer for like mentees and like my inner circle, but you definitely need to know how to do that for sure.
That's fire. Okay. And how do banks analyze exposure?
So they're looking at currently what you have been used to dealing with compared to what's like, I would say like what's currently on your plate. So do you have too much exposure based on your payment trends? If you've never carried $70,000 in debt, and now you're in that season, they're looking to see what you do with carrying this 70,000. How long are you holding on to it? How long, like, are you paying it down? Like, what's the payment trends associated with it? So for me, let's just say that my utilization spiked up and then I showed $150,000 in utilization. The banks would not go and freeze my accounts, or they wouldn't decrease my limits because they've seen me there before. They know that I can pay it back based on the payment trends associated with the exposure that I previously had.
And that goes into what is internal bank scoring based off of that?
Your internal bank scoring is based upon your average daily balance. So they want you to have, like most banks, if you want a low 5, this is what we, these are some good questions that they asking in the chat, because like this is a lot of the in-depth teaching that we discuss in mentorship, my close-knit programs. But internal banking is often abbreviated for like your IBR, which is your internal bank rating. And this is how much money that you have going in and your average daily balance over the past 90 days. So banks are judging you in quarterly segments. Because if you know about trading stocks, you know, banks report earnings quarterly. So they're looking at how valuable you've been over the past quarter. So for each 90 days, they're looking at your deposits, the income velocity, all of those things are super important. And rule of thumb is to have around $10,000 sitting in a checking account at the time of approval. Like that's where we see best limits are at. You could go as low as 2,500, but we don't operate the same way everybody else do. So we do, let's just say, the 5,000 minimum, 10,000, not the typical 2,500.
So you're saying when you getting ready to apply for that credit card, 50 or whatever it might be, have money in the account. That's why they had offered me that when I had got that amount of money in my account. That lady was so eager to push that. And she saw the 3 months prior to me making about how much money I was making. She was like, yo.
And was scaling up. So now, and that's how we position ourselves before we apply for funding, is we have increased consistent deposits. So we start off with 500, then we go to 1,000, then we go to 1,500, then we go to 2,000. On paper, if they look back on a 90-day period, the business is growing in steps. You're not making a large deposit of 10,000 and then you're not putting anything in there and you're just letting it sit. That's a dormant account. So we are building with increased consistent deposits over a significant time frame, at least 90 days. But I've went as far as a year. So I've went $500 a week just coming in every single, and I do it for an entire year. Now they're literally begging me to take credit from them.
And this is why relationships matter so much. It says, how do banks view relationship history?
That's it right there.
That's it. That's the reason why.
We didn't walk in off the street and ask you for your most prized possession, which is access to capital. We dated you. We gave you what you wanted, which was the deposits. And listen, we got to understand how banks truly work. Whenever you understand how they truly work, you understand how to leverage the system. We know they want our deposits.
That's what it's all about. And quick question before you say that. Does a deposit, and I know people want to hear this too, does a deposit, is that, like if I have one bank and client sells me $2,500, but I move that money to another bank, is a Zelle a deposit or not?
Yes. Yes, a Zelle is a deposit. It's not a direct deposit, but it is a form of a deposit. So you can have an ACH, you can have a Zelle, you can have a cash deposit. There's different forms of deposits, and I often tell people to leverage all. Have money coming in from Zelle, have money coming in from your merchant, have cash deposits, have ACH, have direct deposits. If you got an employer that's paying you, the more deposits that you have coming in, the better the relationship is going to be. And like what I was saying was, if we know the banks want our deposits, this is how I don't want to get too technical, but it's called fractional reserve lending. The primary way that a bank makes money is by lending out money. That's the only way that it makes money. Overdraft fees and things like that. But the primary way, if you look at a bank and it's, I would say like its balance sheet, the primary way that a bank makes money or profits is off of interest. But does the bank have money? They don't have money. They have our money that we deposited into their institution. And based on our deposit relationship dictates the relationship that they have with us. So we go in and we understand this part. We know that you only want one thing. So we're going to give you what you want. And you know that we only want one thing. So you give us what we want. Now it's a great relationship. That's why I say banks are nothing more than your business partners. We leverage deposits so they can make money off of our deposits. We don't ask for nothing right away. We wait it out 3, 6, 9, sometimes even 12 months. So the moment that I have a 1-year deposit relationship with you, just depositing money into this account, whenever I come to you and ask you for a $20, $30, $40, $50,000 credit card with my credit score being great or my profile being amazing, you're never going to tell me no. Even better, whenever we take the money off of the credit cards, it's not even our money, and then we deposit it into those banks. So we get 0% funding, take the money off of the card, and then we'll take 90 days to go and build a relationship with PNC, that money that we got from Chase. The original credit card was 0% on the business side, 0% for 12 months. I'm only going to take 90 days out of the first 12 months to go and build with you. So now I put 10,000, 15,000 into your institution in the first 90 days. You now give me an additional 10 or 15,000. I then pay Chase their money back. I still have 9 more months at 0%. And I use the first 3 months to double what I just put in there. It's the name of the game, man. It's like, so credit is a leverage tool, man. Most people look at it to spend money. Like, we leverage credit to get access to more credit, and the more credit that you get access to, the better the opportunities and resources.
What are internal approval algorithms looking for?
So internal approval algorithms, each bank is going to have their own one. So that's a very broad question that someone may have dropped. So internal approval algorithms is probably just based upon their risk exposure, their risk mitigation. They're going to look at some things and say, we don't want to take that risk. And some institutions are going to say, hey, you got 7 new accounts over the past 6 months. That's not as risky to us.
Gotcha.
So it's really based on the institution.
And what's considered aggressive credit seeking behavior?
I would say 4 or more inquiries on your profile in a short time span. So if you get 4 new inquiries that hit your credit profile over the next 30 days, you're aggressively seeking credit. So that's why you can go to certain institutions and they see that you have recent inquiries and you get denied, not from your credit score being low, but they just say you have too many recent new inquiries. So that's why we remove them, like we previously stated, like we go get approved. And then once we get approved, before it actually hits our profile, we remove that inquiry. And a lot of this is taught in my $99 school community, where we talk about how to remove negative information from your credit profile, inquiries, card charge off, collections, a multitude of things, funding sequences, only for $99 a month. So we talk about a lot of that, specifically credit mastery, and that's the name of it, is Reinvented Credit Mastery, because I wanted to reinvent everyone who was watching and not truly understanding. Because let's just be honest. Think about this. Information is only valuable and relevant for 4 years, right? I think we all in the room can agree with that. It's obsolete after 4 years. Realistically, when do you think we get access to certain information? Do you think we're the first to get access to the information or last?
Last.
So whenever we get access to information, it's a certain time frame that we have to execute on it. So if you're relying on free information, first off, if we're giving it to you in a free manner, trust and believe we've leveraged it as much as possible. We know it worked, but you're getting, I would say, leftovers. I'm just going to be honest with you. So that's why it is very important to have access to mentors, to coaching, to a community, to where you get access to information as quickly as possible. The faster that you have access to information, the longer duration of time you have to leverage it.
Information is meant to inform.
Absolutely.
Why do banks shut accounts down?
Not using them, or you're overusing them. So you could get your account shut down. I had about $80,000 in credit shut down on me last year solely because I didn't use it. So it could be from you underutilizing or overutilizing. If you go and run up your credit card and you haven't used it in a year, and it's a $40,000 credit card, and you run it up and then you make the minimum payment for the next, let's just say 6 months on it, they may call it due. Like, I have seen that happen as well. So it's either overutilizing or underutilizing.
And what causes financial reviews? That
it would be a mixture of that, and also your income on your application relevant to your spending habits. If you told them that you made $80,000 a year, and then you go and spend $80,000 the first month on your credit card, that may cause for a financial review. Not necessarily a bad thing, but they could want to give you more money. They're just requesting documentation. And I have seen where a bank requests a financial review, you didn't give them the documentation, and then they shut the account down because you didn't give them the required documentation. So you got to make sure whenever you are putting certain things on the application that your ducks line up.
it's all gonna catch up to you.
For sure. And now with AI, man, like it's hard to beat like the algorithm. Let's just be truthful as possible with a 20. Listen, this is the rule of thumb right here. Be as truthful as possible with 20 to 25% inflated information, because you expect your business to grow on average 20 to 25% a year. If you can't provide those documentation or provide that documentation, it was a reasonable guess. We projected a 20 to 25% growth based on our previous years in business. Versus you saying I made 1.5 million in business, you only make 100,000. Now, how can you treat 150% growth? That's unrealistic. Now you're lying. But with 20 to 25% based on the average of the industry, that's where we get the numbers from. The numbers have to make sense. And if you can portray your number that way,
good.
You're good.
How do charge cards differ from revolving cards?
That's a great question. Charge cards are something that's either going to be due in an interim, 30, 60, 90. And a credit card can give you a 0% interest rate, and you can carry a balance on it as long as you need to. Typically, a charge card would need to be paid off in full, a standard one every 30 days. So you could get, $100,000 on a charge card, but the $100,000 must be paid back in 30 days. Or if you have the Amex Plum, you can pay it back in 60 days. So it's going to differ per issuer and institution. But I always say, I love credit cards. I love credit cards. If you're spending a lot on ad spend, the American Express Gold, that's a great one. You're going to get 4x back, but in the hopes that you are spending money on ads, you're at least breaking even.
Got you. Why do some people get approved for massive limits?
It's that profile. They're properly position themselves with the correct profile to show that they can handle the large limits.
When should you start really looking at your profile very seriously.
Man, yesterday.
There you go.
Yesterday. Like, this is something, man, I'm a retired warehouse worker. Like, this one niche and credit branches out to so many different ways. Once you get access to it, you can build anything. Like the studio that we in, credit built this, bro.
Facts.
You see what I'm saying? Like, you had to leverage credit to get access to the resources. Because if you don't have credit, this is my opinion, you can have all the money in the world. If you don't have credit, you can't even get in certain rooms.
Facts. 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 And how do lenders determine starting limits?
Ooh, that's a good one. They determine based on your previous history and payment trends.
Okay.
Previous limits and payment trends.
And what causes limit decreases?
Not using it properly, showing that you are, I would say, like over leveraged in a sense, and then that truly stops you from getting access to, maximum exposure. Even beyond that, it's going to be a situation to where they decrease your limits if you don't use them.
Good. We went over a lot of great questions. What is, in detail, like business credit?
That's a very broad question, but if I had to break down business credit in my sense, I would say business credit is a hidden way to access capital without other banks knowing. Because outside of Capital One, TD Bank, and Discover, no other issuer is going to report what you do on the business side to your personal profile. I would also deem it as your second self. Because once again, you got two different profiles. You got your individual profile with your social security number, but you get an additional social security number with the business known as your EIN. So I would say it's like you literally wanted to clone yourself from the personal side. So I would say a hidden way to access capital without other banks judging you or knowing.
And would you say that ties in the difference between the personal and business credit, obviously?
Yeah, so business credit is outside of those institutions that we just named. They're not going to report to it. But if you max out, for example, your personal credit card, it's going to affect you. Like your credit score is going to fall. Then it's going to be harder for you to get access to certain limits, so on and so forth. So business credit is an opportunity for you to, once again, like hide behind. And it's not literally that, because I talk about it a lot more in depth. But it's a way to hide behind personal debt in a sense. It's not the full story, but it's a way to, if you are in personal, let's just say personal debt, you could then get a business and then take your personal debt, push it over to that business. Now your profile is still amazing, assuming you don't try to go and get funding under that business. This is another strategy. You could have a lot of personal credit cards utilization, open up a business, then get funded under this business, right? Build it up, and then push this personal to business one, have a second business, and then you can use your great profile to get funded for the second business because all of the debt is under that first business. So it's ways around it, man. Yeah, these questions pulling a lot out of me. I like this.
And obviously we know this, but I just want to make sure everybody knows, do people need an LLC to get funding?
No. You don't. You can go through and get funding as a sole proprietor. So you don't even need an EIN to get business funding. Chase, American Express, a lot of institutions will offer you what they call sole proprietorship. So you can go get business funding under your personal name. Everybody should also be a business themselves. Have yourself as an actual business.
What is a personal guarantee?
A personal guarantee is whenever you co-sign on behalf of the business. Often people want to go to no PG funding, but unless you're doing 4 million plus a year, you're not going to get to corporate credit. Corporate credit is whenever it doesn't require a personal guarantor, meaning that the business can, let's just say, stand up for itself. It's making so much revenue, it doesn't need you to co-sign on behalf of it.
Dang, hold on. At first, when we first started this, I was thinking like, okay, the business that makes it seems like you have, I think of it as another you.
Mm-hmm.
It's the baby starting out. Here goes the food you're giving the baby,
Mm-hmm.
growing it, boom, boom, boom. But if you start really scaling, then you have what you just said, your PG is where like my business is scaled. Now this is a grown man.
Mm-hmm.
It's standing on its own. It can do for without me.
Exactly. That's what no PG is. So no personal guarantor, 4 million plus a year can literally go out and get access to corporate credit, and you're not even tied into it. So you go with EIN, documentation to the institution, they give you corporate credit. So like you see most of these major, let's just say corporations, they have like a corporate credit card. And it's not tied to the CEO.
The CEO, the founders.
Exactly, because the business
And that's
is
how they
staying.
hide themselves.
You see what I'm saying?
That's why you just said, oh no, that's why they can hide their self, because at the end of the day, they're making so much bread that they're detached from the business. But then also when you think about business, that's what you want, because I don't want to be the exit plan.
Yes.
What are we doing here eventually? Like I just heard we was on a call with another guy a while back from Tampa, not to get into it, but he was just saying like, I'm gonna have my business forever. I love this. No, I believe you can't do that really, because you might die one day, and then what does the business do? So you really always have to come in the mindset of having an exit plan and scaling that business to then sell it or to be detached from it to the point where somebody else takes over it. But no, okay, that's and I never knew what PG meant. I didn't even that's just opened up my whole mentality on like why people really set themselves apart from the business. What makes a business fundable when it comes down to, business funding?
It would be that you set up properly. So you can still go and get business funding under a sole proprietorship, but specifically business funding, having the correct entity structure, LLC or corporation, right? Making sure all of the documentation match up across the Secretary of State, the EIN, like everything matches up, but it's making sure you're just basically fine tuning, the details of the business. And then you can walk in with a day old LLC and get access to 200,000-300,000. Like you don't have to have age specifically with credit cards.
And then when it comes to applying, how long should a business exist before they, because you
can literally, like I said, you can have a day old LLC and go and get funding, but depending on the product that you go for is going to dictate how long you got to be in business. You go to Wells Fargo for a business line of credit, they're going to tell you at least need to be in business for 1 year, because it's hard to give you business just started yesterday, $100,000 on a business line of credit. So it varies. That's specifically with Wells Fargo. Other institutions may say 6 months. Some institutions may not have an age requirements for a business line of credit. So it's solely depending on like which institutions you go to. And that's why we talk about auditing the bank so much. It's like knowing what are the requirements for you. Because if a female came up and approached you or Divine, they got to have certain requirements or qualifications before they can even talk to you any further.
Come on now.
You see what I'm saying? So the bank, whenever we go to the bank, we got to meet their requirements for them to do business with us. But if they don't want to do business with us, we got thousands and thousands of other institutions that will. And it may not be that particular product, but that's why I say it's great to have multiple LLCs. Just having a stash, pay the annual fees, and keep up to date with the Secretary of State. And now, whenever you get to 2-3 years in business, you're now qualified for certain types of funding.
And this is why startups, this is what they should be looking into when it comes to qualifying for funding when you have a startup, pretty much.
Yes, for sure.
Okay.
Mm-hmm.
Okay. What documents do lenders require?
It's going to vary. But it's going to be a lengthy response, but it's going to vary per the consumer or borrower and per the institution. which goes right back into auditing the bank and understanding, you know, if you go to, let's just say, Bank of America, and you try to get a $100,000 business line of credit, they're going to require tax returns. They may file a UCC-1, and they may ask you for bank statements. They may ask you for a multitude of things, balance sheet. They may ask you for a list of series. So each institution, some of them are more strict than others, but, you know, some of them, you know, we never say this terminology at the bank, but we like to leverage what they call no documentation banks. Where they don't ask you for no documentation. Everything is stated income, projected revenue.
So when you say that's your revenue, and that's why it matters so much for what you've been making in the past, so that you don't have to do the documentation part.
So like you could go to American Express, and always be prepared for a financial audit, because whenever we say no documentation, they're not going to ask you for docs. Most people are going to say, well, I'm going to put that I made 3 million. I'm going to put that I made 5 million. Well, now you're not being all the way truthful. And if they think that you're lying, you're definitely not going to get an approval.
Fact.
So why not be realistic? Because, bro, the average person is only making $40,000 to $50,000 a year. So there's nothing wrong with you putting those numbers on the application and then working your way up. Because what if you use those numbers, they give you access to a high limit, and then in 90 days from then, they come back and say, well, we just want to make sure everything is okay. We're going to do like a simple financial audit just to make sure, you know, everything is aligned. You don't give them the paperwork. And if you don't give them that paperwork, they now shut down the high limit credit card that you had access to and call it due in full.
You really could be messing yourself up.
All because you overinflated. 20 to 25%, man. That's all.
20 to 25%.
You want your business to grow 20 to 25% annually.
How do banks verify business revenue?
Bank statements, 4506, or you directly giving them a copy of your tax returns.
That's right.
A 4506 is whenever they go directly to the IRS and they say, hey, did Dub Washington make X amount this year?
They're probably doing that to the people that's making them corporate.
You see what I'm saying? And then that's exactly.
Because they
do a 4506. Of course, some people argue that you got to give them permission, but I mean, technically. But we're not going to go down that rabbit hole.
Okay. What is a business line of credit?
A business line of credit is access to quick liquidity in layman's terms. So it's whenever you go in, you apply for a $50,000 business line of credit. Now it is available in the form of a business line of credit. You can then transfer it directly to your checkings account. Some of them may do it same day. Some may do 24 hours. And then you have access to some quick cash. The thing about that is they're going to charge you interest, and you got to know the terms associated with it. I've done another video breaking down like business line of credit masteries on the channel, and we'll probably put that link in the description here for you to go and understand the difference between a true business line of credit and a true true business line of credit.
Got you. Oh, so you was pretty much the same difference between a line of credit and a loan.
Yeah, so a loan will be where you locked into a repayment period.
Okay.
But sometimes, definitely go check out the video, sometimes you could get a line of credit that's treated as a loan. So a loan traditionally gives you a same amount over a time frame. You borrow $50,000, you can do $2,000 a month for 72 months. It's going to be interest and everything tied into it, right? And they're going to get a little bit off the top, right? Or, you can fluctuate it. But once you pay that off, you can't use that loan again. You got to get an additional loan to get more money versus a line of credit. Whenever you go in and you borrow the money and you pay it back, you can then use that same money again.
Gotcha.
But you need installment and revolving on your profile for sure.
To be able to access.
Yeah, it's best rule of thumb to have both.
Got you. What is a DUNS number?
A DUNS number is a 9-digit social security number for the business to where they just monitor your payment history, and it's pretty much another version of a credit profile for a business. So it's Duns and Bradstreet. A lot of people get caught up in building up their Duns profile and all these things, but typically a bank is not going to lend off of your Duns number. They lend off of SBFE, SBSS, Equifax, failure score, Experian, and Teller score. So it's a multitude of things, but that is specifically another, pretty much like a business credit bureau.
Okay. And you said SBFE, SBSS. If you could break down those two.
Small Business Financial Exchange is SBFE. Small Business Scoring System is SBSS. So once again, these are true business scoring models. NAV is not it. Duns and Bradstreet is not it. Banks don't lend off of those. They lend off of Equifax business scores. They lend off of Experian business scores. And then in each of these, you have the SBFE, SBSS. And also, while we're talking about business credit, understand this. Sometimes what happens is you can go and get a business credit card and it reports to the SBFE. And if you're over leveraged for that, that pretty much determines the limit that you get from an institution. So you go and apply for a business credit card. They pull your personal credit. They then pull your business credit. And then they see the debt that you're carrying on the business side. So we spoke previously about taking your personal, moving it over to the business. But if you're trying to get funding under this particular business, what happens is you got to keep that in mind that they're reporting, some cards are reporting to the SBFE. And then if you say that you make $300,000 in a year, but you're carrying $300,000 in credit card utilization, what are you doing here? So it's going to take you a year to pay this off. So you wonder why you get approved for a $5,000 limit, because it's going to take you a year to pay off what you already owe. You want me to give you an additional $100,000? It don't work like that.
This is what David Shanks was saying yesterday.
It don't work like that.
I get you saying. So do you have to real deal work on paying that off as quick as possible, so then they trust you more, so then you can get access to more? Mm-hmm. Got you. Can business credit exist without personal credit? I've always wondered.
Can business credit exist without personal credit? Yes, but not true business credit. So you can go and get some net 7s and net 30s and everything, and they don't need to pull your personal credit. You can just go and get it on behalf of the business, and it's a whole bunch of net accounts. You got to connect your checking account to it, and they do automatic draws every 7 days, every 14, every 60, every 90 days. So you can, but it's not traditional funding like we like. It's not the 0%.
Gotcha. And last one, what industries are considered high risk?
Ooh, this is a good one. So technically, high risk industries would contain marijuana, adult television, trucking, real estate, the general high risk NAICS code. But now what a lot of people don't understand is consulting is deemed as high risk based on the payments or the defaulted payments of a lot of people that went out, built these consulting firms or businesses, and then they ran off on a bank. So you got to look at this from the banker's perspective. What industry is the highest defaulted NAICS? We were told, go out, create a consulting business and go get capital from the institutions, right?
Yeah.
But what if over the past 3 to 4 years, the consulting businesses are the ones who's been running off on the bank?
I see it. Yep.
We haven't been paying it back. So at the time of this recording, 2026, consulting is a very high risk NAICS code in the form of default or delinquency rates.
And the next code is just something how they're tracking
what you do in business. Gotcha. So yours would be videography. Yours would be marketing. So always have a SIC code, SIC code, as I would say like another form of the business or another niche of the business, because you can have a consulting, but it's specifically marketing consulting. Yeah. You can have a trucking business, but you could be, if I'm not mistaken, 541619 is consulting for logistics. Yeah. So you got to know like how to position your actual NAICS code to get maximum exposure from the banks.
So what is a NAICS code? And I know you know the abbreviation for that better than me. Why does it truly matter?
So the NAICS code, we talked about that previously, is basically the industry that your business operates in. So very similar to the analogy that I gave earlier about instead of you going to get a general trucking NAICS code, right? The logistics company. If you know that specific NAICS are high risk, you going out and operating under a lower risk NAICS that services that high risk now positions you for better approvals. Because at the end of the day, let's just call a spade a spade. The goal in business is one, to make money, but the fastest way for you to make money is by getting access to capital. If you try to save up 100,000, it's going to take you the time. But if you know structure of the business, the NAICS code, all of those sequencing, all of those great factors, you can go and get $100,000 tomorrow from the bank and get your trucking business started in no time, versus you trying to save it up and build up, and you're wasting time. So you knowing which NAICS code to operate under, which ones are considered high risk at certain institutions, that is very beneficial in your overall business's growth.
And how do banks analyze industry risk?
That's a great question. They analyze the industry risk solely based on what have other business owners in your NAICS done over the past 12 months. So like we talked about it earlier, if you go to KeyBank and you have a consulting business and you try to go in and request 50,000 or 100,000, more than likely they're going to deny you, even with an 850 credit score, perfect credit score, perfect profile. They've been burned with consulting businesses. Like in 2024, the way that people was running through KeyBank with that business credit card and business line of credit and not paying it back from 541611 NAICS code, bro, they don't want to have nothing to do with that NAICS code no more unless you have a long-lasting relationship. So they analyze the risk associated, what other people have done in your specific industry.
And when you think about that, I know something's called UCC filing. What is that?
So it's a uniform commercial code filing to where they are placing a lien on your assets. So if you go and request 300,000 from Chase Bank, which you can, you're going to request 300,000 from Chase Bank. If you have the documents, you have the qualifications, the profile is good, great relationship, deposit relationship, all of that, you can get it. But then that 300,000 stops you from going to another institution getting access to capital. So whenever you have a UCC1 placed on the business, this is essentially me borrowing 100,000 from you, and then you're telling Devon that you just gave me 100,000. So if I try to go to Devon next week and say, let me borrow 100,000, more than likely he's not going to give it to me because he knows that I already owe you 100,000. So the banks are the same exact way. If you get a UCC1, they're saying, hey, I want to get first position on the assets in case he defaults on it. And if you don't got first position and then I run off on you, you're not getting your money back. Devon gonna say, listen, I can't do it because Jeremiah has first position. He has a lien on the assets. In case you default on paying him back, it could be accounts receivable. It could be invoices that you have currently unpaid, that so whenever they do come in, they could literally seize all of those as well. They have first dibs on the assets of the business. It could be inventory. It could be accounts receivable. It could be contracts. It could be a multitude of things. So that's essentially what a UCC1 and UCC1 is, and is also different forms of it, because you also got to look and say, is this a blanket lien, which is a form of a UCC1, and that blanket lien is full blown out. Anything that you have in that business belongs to me in the form of a default. But just a general UCC1, it may be a percentage of what you got.
Got you. And this is like you saying that lenders request bank statements because of.
Yeah, they got to see that you are like doing what you are supposed to do. And whenever I say we build a deposit relationship, let's say that you go to an institution, there's no documentation, right? We walk in, you don't have to provide no documentation to get access to 50,000. But if I already have a deposit relationship with you with increased consistent deposits over the past 90 days, you know what you do have? Documentation. You have bank statements directly with you. You don't have to ask me for it because I've been building with you. So we go to no documentation banks, but we give them more documentation that they ask for in the form of bank statements because we are building with you. And then that's how we get access to the super high limits. While everybody else go in and they hear there's no documentation, they don't build with them. And then they wonder why they get a $10,000 limit while me and my mentees get a $50,000 limit.
And that can literally go into also understanding deposit velocity.
Yes, it goes directly into that. Deposit velocity is literally exactly what that is. The velocity of the deposits. $500 a week, $1,000 a week, $1,500 a week, $2,000 a week, and you're building up. You don't want to go backwards. You don't want to go $10,000 deposit, then an $8,000 deposit, then a $5,000. It looks like your business is shrinking versus growing. So instead of putting one large, and let's use a real example, instead of putting one $32,000 deposit into the institution, you could have done it in another way. Like, yes, you got paid because it came through a merchant, but now you can take that $32,000, then you could go to X Credit Union, or you could go to Coosa Valley Bank or whoever, right? And then you start building out with the money that you had come in, and you start building with them. So Chase see the 32 come in, but then you also go to another bank and let them see frequent deposits coming in there. So Chase is going to lend to you off of the merchant deposits. Now the other bank is going to lend to you off of the consumer deposits coming in, and you're able to leverage both banks to get access to money.
The blood clot.
You see, listen, it gets fun, man. Listen, we leverage, listen, man, it has often been said that before you spend the money, it's supposed to make 3 moves. So when the money come in, you can make an investment, you can make a deposit, you can invest into someone or something, but you need to make 3 moves before it go back out, meaning that it departs from you. So whenever I get money coming in, it can either go to stocks, it can either go to brokerage account, it can either go to deposit relationship, it can either go to investment, but at least needs 3 steps before I say I'm ready to depart with you on a liability.
That's deep.
And the reason why I say 3 is because you could get it and put it in one place, and then it may not move. It may stay stagnant. You may put $1 here in ad spend, and it don't bring back nothing. It may bring $1 back. Okay, cool. But now let me put it into this particular avenue. One of the best things that you could put it into is a deposit relationship, because you can't lose with that. You can never lose by going to put money into another bank. I get money from a credit card, I liquidate it, I then go and deposit into a bank. Now you lend to me based off a deposit of money that's not even mine.
This is why God was talking about with the 3 kings.
Oh, listen,
Bro, I just saw it.
Matthew 25:14. Go read it for yourself and educate yourself.
Oh, that just gave me the chills.
Matthew 25 verse 14, whenever he started off, he entrusted 3 different men with different talents. One he left with 5, one he left with 2, one he left with 1. It's multiple ways in which we can go with this. Because in the comparison era that we in, you on Instagram and you looking at what this person done. They made $1 million a day and they did this. What are you doing with the one that you got? So the one who had 1 wanted to be secure. So he went out and buried it.
Yep.
What did the ruler say to him? He said, you slothful and lazy servant. You could have at least departed with the money and placed it into a bank to where I can gain interest. Listen, he told him what to do. He said, you could have taken the money and put it into a bank to gain interest. If he would have at least done that, he wouldn't have been slothful and lazy. So you don't got to put your money into this investment, real estate, stocks, and growing the business and get access to capital and put it in the bank. That's what make the banks compete to lend you money come from. Everything should be based from a biblical principle in life. You slothful and lazy servant.
Yeah.
But back to the point of you comparison. You looking with somebody with 5 talents were done. You were so busy watching them that you didn't do nothing with what you had. The person with 5 went and invested it and got 10. The person with 2 went and invested it and got 4. The person with 1 buried it. So then it was taken from them and gave to the person with 10. You got me off my, you got me going with that one now.
Yo. And then that goes right into the next question also. This is why banks care about your average daily balance.
Average daily balance increased consistent
time.
over time.
Got you.
90 day, 180 day, 9 months, 12 months. As long as the average daily balance is growing, they know the business is growing. Because who's to say that that's the only account that I have?
True. Very true.
That's why we leverage multiple.
Because, dang, okay, I get what you're saying. Because they only talk to each other when, so I guess something bad has happened.
Yes, they mainly only communicate when something bad happens. So American Express, Chase, like a lot of these institutions only report negative activity. Some Bank of America, PNC, they will report if you have utilization, but majority of the time, a lot of them are only going to report negative activity.
How do banks analyze existing business debt?
So it falls into the exposure. That's why I tell people to have multiple entities, because if you have, let's just say, 300,000 in business credit debt, and you're only making 300,000 a year, and they can see this because the institutions that you go to report this information, you're high risk. It's going to take you an entire year to pay it off based on bank statements and actually what you're providing in the form of this application. If they ask for bank statements, tax returns, so on and so forth. So they're looking at what you currently owe versus how much you make and determining if you qualify for that.
And this is also why this can go into businesses get denied despite the revenue at times.
Yes. Yeah, because you make 300,000 in a year. You make $1 million in a year, but you're holding so much in debt. Like you haven't even paid back the original creditors that you took out loans with in the beginning. So you're trying to come and get access to more capital, but you haven't paid back what you've been borrowed from 2 years ago. That's why pay down periods are so important. And this is listen, man, we could go so deep. This has been a masterclass, man. I hope y'all are enjoying this, right? But this is why the importance of, if you have debt, at least paying it down. I say quarterly as a rule of thumb, but if you can go biannually every 6 months to pay down what you owe, that puts you in great position because it shows that, hey, you know, that you can handle the debt that you currently have. And then if you are carrying balances, who's to say that you're not making money off of that? Do not let me ever tell you that you carrying balances is a bad thing.
Facts.
Because if you're paying 17% APR on a line of credit for 100,000, so for you having access to this, you're going to pay 117,000 minus the origination fees. So 100,000, you pay 117,000 a year. But if this 100,000 is making you, let's just say, 134,000, you're now profiting $17,000 annually. And you're giving them their money, they're making money off of you, and you're building a quality relationship because they know that you can pay the debt back.
That's why it can go so many ways.
So some people carry balances doesn't always mean financial instability.
Facts.
Sometimes, like, as long as I'm making more money than the interest is, that's a win. I'm borrowing free money.
Facts.
You're dipping in profits, but you're still borrowing free money. This money is making me money, which means that it's free.
And what is exposure per entity?
Exposure per entity is a banking term that institutions, whether it's a bank or credit union, will give you access up to a certain amount per entity. So you could have an entity exposure of 150,000. Meaning that's the most that you can get under a particular entity, whether it is a personal profile, because you are an entity with your social security number, or it's a different business entity. So sometimes it could be product exposure, max exposure, entity exposure. It's a different multitude of, verbiage that the bank like to use.
Got you. Now, this is a general, then you talk about this a lot, but it still needs to be asked. What is relationship banking?
Man, relationship banking is what we kind of talk about every single day, is you going in and establishing a relationship, at least 90 days, going in, depositing money into that institution, and not just only making deposit, taking money out, letting them see the ebbs and flows of revenue, right? The ebbs and flows of income. You got to understand that banks like to see organic behaviors. You just coming in and only making deposits, they ain't necessarily like what the average person is doing. They want to see you come in, you drop a few thousand, then you take it out. Then whenever you come back the next time, you put that 2,000 plus 4,000. What is that like? The algorithm is saying that he know how to leverage money. And if you know how to leverage specifically capital, they're going to be more willing to give you access to more money. So you go in, you make a $10,000 deposit or $8,000 deposit. And the next week you come in and withdraw 3,000. Now you come back and deposit an additional 8,000 on top of the 3,000.
Okay. What causes lenders to request tax returns?
Man, it's you lying on applications like most people do. The fastest way for a lender to request tax returns is that they think you lying. You see what I'm saying?
Yeah, gotta stop that.
Like you say that you make 1.5 million and you only make 100,000, but it's you going in and putting more than what you actually make, and it don't seem realistic.
Facts.
You see what I'm saying? Like, I see so many different things, and so many people come to me and say, "Dub, I seen these data points. We're gonna use this," and I'm like, "Bro, nah,
Don't even
it's
try.
not realistic."
Don't even try it. What is low doc versus no doc lending? I know you talk about that a lot.
Low doc will be bank statements. No doc will mean like they need no documentation.
Okay.
At bare minimum though, for us and how we operate, we at least have 90 days of increased consistent deposits. Like
And who you talking about?
bare
us?
minimum.
You talking about your school community?
Yeah, my school community, my mentees, like some of us, if you have access to a little bit more liquidity, we may go 6 months out to a year. And that's just us positioning for large lines of credit.
And
so imagine going in for $1,000 a week for a consistent year. That's about 50,000 at the end of the year at that institution. And we're just positioning, you know what I'm saying? You can increase. And that's like truly how we leverage to get access to super high limits, because the deposit relationship is so strong and we never ask you for nothing.
And so I've been in your school community. These are high level individuals. You guys are moving money, moving serious money. What is the type of person, you got two different school communities. What is the type of person that should be, trying to attain that knowledge that you got? Because I've been in there. I'm like, yo, this is.
Yeah. So I would say for someone just looking to master credit in particular, this would be more of the $99 a month school community, because they're just trying to get, it's called Reinvented Credit Mastery. We specifically focus on credit, how to leverage it, how to get access to it. But if you want to then know what to do, how to audit banks, how to literally go in and make this money make you more money. So we're talking about funnels, we're talking about ads, we're talking about content creation, we're talking about a multitude of things. We got about 40 extra stream of income calls. So any idea that you could think of with leveraging the capital, then this would be for the $2,500 offer. But like I say, if you just want to just know master credit part, then you can come into that $99 school. You get more information in $99 than most people are selling for $20,000. You see what I'm saying? Because I'm allowing you to literally come on once a month and do what we just did here. Ask me questions specifically pertaining to where you are.
All right, that's fire.
Because it's everybody's at different places.
Stages,
Everybody has different goals. And I've taught and mentored and consulted with so many people. Like I can just, okay, what are you trying to do? How long is it? Okay, let's come over this developed strategy. Like I could wake up 3 o'clock in the morning out my sleep, like, what's good? And then we could just go to strategizing. Just because like I truly study this.
Yes. And, doing all this and understanding all this, right now we are in, like, the economy is in a, I'm going to say horrible, but I would say we're in a learning phase, or we're getting back up there. How does lenders evaluate risk during this, like, economy, like, tight? I would say it's like a tightening position, right?
So we've been in tightening. Lending has been tightening over the past 2 years, since 2023, late 23. And now, based on what I'm seeing with Chase building rolling out the American Dream Initiative, they put $80 billion to go out just directly to small businesses. So for me, in my opinion, and my research, it seems like the floodgates are about to be open.
Better get right the right way.
Positioning is key.
Yes.
And that's why I come and drop this free information for people to get in position, because everyone getting in position doesn't stop me from getting access to capital.
Facts.
So I would say like right now, like the way that the banks look at the current lending or the current economy, lending economy is different than the economy. You see what I'm saying?
Facts. Two different separate
The
things.
bank must lend out money to make money. They will never ever stop lending out money. So as you understand this clearly, everything else is like what Jeezy said. Everything else, cake and ice cream.
What financial habits makes banks trust you more?
Man, using the credit, running it up and paying it back, pay down periods, having access to large lines. Like it's like levels to it. You want to go in and you want to show that you can handle 10,000. Then you want to show that you can handle 20,000. Then you want to show that you can handle 50,000. Then you want to show that you can handle 100. And you keep scaling up, and they like to see that, because whenever they see that you can handle access to large lines of capital, they know they can make more money off you. It's very similar to like in our businesses.
Yeah.
What's the average lifetime value of a client? So if you know that this person can borrow X amount, and I'm charging him, let's just say 3% interest on whatever he borrowed, the way to get more money off of him from the bank is to lend him more money.
Facts. Yeah.
You see, it's
Yeah,
very
it's-
simple. Like,
yeah.
how can we lend you more money?
Yep.
And that's the position that everybody should be in, is that you have banks calling you. Like, I have bankers call me all the time. Listen, Mr. Washington, your file came across our desk. Anything that you need, please reach out to me. They want a commission off of me, because we talked about this before. Is bankers get paid off of money that you spend on those cars. It's a small percentage. They get a commission off the approvals. They get commission off opening up the checking accounts and how much you're spending on these lines of credits and these credit cards. That's why they value high lifetime value clients.
And how do wealthy individuals use leverage differently than average consumers?
Man, we don't spend money for the sole sake of spending it. If it can't return back to me with more, then we really don't got no place together.
That's all energy in life.
Exactly. It's about most people, they get access to credit and then they want to go to Miami. They want to they want to, take a trip. Nothing wrong with that, by the way. But the difference on how wealthy people leverage it and the average consumer is, we're going to get the credit. We're going to put the credit to work, because it's made up of imaginary numbers, a 3-digit number. Hopefully it starts with the 8 for everybody that's watching this, 800 plus. And then we go to these banks, we get access to the money, and then we put the money to work, and then we chill with our kids and take them on nice trips, and then the credit pays for it. Like, I can't tell you the last time that this is probably, how would I say it? Like, this is probably one of the things that most people don't understand, is like the trips that people pay for with their hard-earned money. If you learn how to leverage credit correctly, that same trip is paid for with credit card reward points. So I'm not having to pay for these trips. Me, the wife, and kids are traveling on the behalf of American Express, on behalf of Chase. And that's how we leverage it. We don't spend money. We allow the credit to fund our lifestyle while it also makes us money.
And that was the last question, but I got one more last one that just is off subject, but it made me think the banks have an offer that's truly always going to keep you coming back if you treat them right.
For sure. It's
And-
always offers that's not even publicly. And now since we answered all the questions, let's turn it into a masterclass to let people know what they don't know is the most expensive thing ever in life. And the bank will always have non-marketed products. If you make enough and that relationship is strong enough, you can get access to products that you don't even know that they have.
It's a game, boy.
It's a game inside of a game. Imagine what you could do if you got, and this number is going to scare some people, but if you got access to $1 million, most people wouldn't want to touch it. They would bury it. They would be the slothful and lazy servant and bury it, while other of us would take it and double it,
Generational wealth.
put you in position. Some people, I don't need that. I'll blow it. Well, you already coming in with the wrong mindset. That's why you don't have it.
Mm.
Versus you saying, man, if you gave me access to $1 million, you don't even got to have a plan. You can take it and put it in the bank.
Yeah.
You can get $1 million in credit and strategically open up checking accounts. And it's called, listen, it's called check account churning. To where you can go and deposit money into institutions and they pay you for depositing money into those institutions. Bankrewards.io allows you to do this. So you can go out, get you a $10,000 credit card, 0% interest for a year, and then you could leverage. Some of them are going to tell you make a direct deposit of $500 within 30 days and they'll give you $250. You've now taken $1,000, put it into the institution, and they gave you $250. You up to $50, and you didn't even use your own money.
You profit in so many different ways.
You can make $10,000 to $15,000 a year just doing this strategy here. Just to go and open up banking accounts, take credit, pull the money off the card, go and open up checking accounts, and you can make $10,000 a year. That $10,000 a year can now pay for travel of the family, can now pay for designer. It don't make sense to buy liabilities. Like whenever I see people paying for stuff, it just hurt my heart. I go in Saks and Neiman all the time, and I see people pulling out money, and I'm like, bro, you just spent $4,000-$5,000 on this. If you would have put it on a credit card and you got 10% cash back, not a lot, but that was $60 of cash back. You was already gonna spend the money anyway. Why not get some of it back?
Facts.
Or you invest into the business and you run ads and you get 4x on your Amex Gold, and then the ad spend that you're spending giving you 4% cash back. You take that 4%, you spend $100,000 on ads, it's $4,000. Now you take that $4,000, you can go to a mirror, you can go and buy all of that stuff off of the extras, and you invest it into your business and you won that way. So you gain clients, you made money. Now the credit card that you used gave you money back for using it. And then we take the extras, which is the points or cash back. And then we take that and throw that into vacation, and we throw that into designer clothes. And so many people put so much meaning onto tangible things that don't mean nothing. So family,
I was gonna say,
with that being said, man, I hope y'all enjoyed this. Keep the questions, the comments, the concerns, keep them all coming so we can serve you better. And that's what we do. We, one, make sure that everybody eats. And secondly, we make the banks compete to lend you money. So we want to see more questions, comments, concerns in the comments. And we'll see you on the next one. God bless. Let's eat.